Diplomatic digs or cross-country political bashing is something many of us have not just witnessed but have also enjoyed. But dirty laundry being aired publicly, which is something that has been restricted to the political arena, has now found itself in the ring of regulators as well. A fortnight ago, the European Securities and Markets Authority, or ESMA, said it wants to govern Indian trade clearing bodies. Unsurprisingly, the RBI and SEBI said, nothing doing. Or like we say in Chennai, chance illa. ESMA retaliated by derecognizing or withdrawing recognition of 6 Indian clearing bodies. But what is the rift really all about? What is irking the EU regulator? And as the rift increases, who will blink first? The questions are many, and I will be honest, I'm also seeking answers here. Many of you would be familiar with the ET in the Classroom segment. I used to write a few of those too, and this episode reminded me of that time. I have a lot of questions, and I decided it would be best for me to take a back seat and learn on this episode with you. It is Friday, November 25th. I'm your host, Rekhi, and you are listening to India vs. Europe Regulatory Rift on the Morning Brief from the Economic Times. Before I even get started on the deep dive, I had to understand who and what role does the central character play. In this case, it's the clearinghouse. Well, to put it simply, a clearing corporation is an organization associated with an exchange to handle the confirmation, settlement, and delivery of transactions. So basically, if I want to sell 10 shares of Reliance and you want to buy 20 shares of Reliance, the clearing corporation has the task of helping me sell my 10 shares and to help you get 10 more shares from someone else so that both the transactions take place seamlessly. Well, now that that's out of the way, it's time to seek answers to some of the tougher questions in this regulator rift. Like in a game show, in my quest for answers, it was my turn to use the phone a friend option, and on the receiving end of the call was my colleague and the executive producer of TMB, Anirban Chowdhury, and also ET's associate editor, Sugata Ghosh, who is the go-to person at ET for all things markets and regulation. Thankfully, the two of them broke it down to the basics.
Hi, Sugata. Very warm welcome to the Morning Brief.
Hi.
So, you've been covering the standoff between European financial regulators and Indian regulators such as RBI and SEBI pretty closely. Now, to a lay reader, it comes across as an overreach where a foreign regulator is imposing its conditions on local regulators. What's the genesis of this?
Well, a lot of new rules which you see in the market today go back to the meltdown of 2008. Now, that was when the regulators felt that they need a better grip on the markets. They need to know what kind of transactions are happening. The banks, which are custodian of customer deposits, whether they have the wherewithal to do those trades, are they being too reckless? And particularly the counterparties, which are large institutions that stand as an intermediary between two banks dealing, whether they are strong enough to do these transactions. Because the regulators don't want to be thrown into a surprise once again. So that's where the current debate revolves around the stature of the counterparties and the regulatory overlap that is playing out. Now, central counterparties are in the middle of most transactions. Now, they're important because they take the risk. They absorb the risk of settlement and clearing.
Right.
So if two banks are buying or selling securities, it is the responsibility of the central counterparty, or CCPs as they're called, to see that the seller receives the money and the buyer receives the security. Right?
Okay.
So they assume all the risk. They play a crucial role of an intermediary, and given their importance, the European regulator, they believe that they must have some supervisory powers over all these CCPs. that
Right.
deal with European banks. So the central counterparties like the Clearing Corporation of India, through which all this bond, forex derivatives, money market transactions happen, or the NSE Clearing Corporation, through which the stock trades done on NSE, which is the India's largest stock exchange, those happen. They want to supervise those. They want to do on-site inspection. They want to see whether they have the risk mitigating measures. And if necessary, they can even fine them. All this is unacceptable to RBI and SEBI.
Right.
Now, this has been brewing more than a year.
Okay. And how serious is this issue?
I tend to believe that as of now, it may come across as a bit of a regulatory paranoia, but there is no other way for the regulators but to sit together and sort this out. Because you tell me, what else is the solution? The European banks, some of which have been for close to 100 years, and they've been doing business here, they will have to cut down their business. The business, that particular volumes on those businesses will be taken over by other multinationals like Citi or JP Morgan, the American banks.
Right.
Or the European banks will have to set up a non-bank entities and do those businesses. Right. Now, that means more time, more overhead, more cost. And all this does not bode well for some of the Indian financial markets. So it's necessary that the regulators find a way out and they strike some deal.
Sugata, if I understand you correctly, quite a bit is at stake, right? So we are talking about different markets here: foreign exchange, sovereign bonds, derivatives, and even stocks, right? Some of these negotiations have been going on for quite some time. So why has it reached this stage?
So this cold tussle between European regulators and Indian regulators, it has turned into some kind of an ego war. So the stand taken by our regulators like RBI or SEBI, particularly RBI, I mean, there may be good reasons for that. RBI may have reasons to refuse ESMA's demands. After all, what is ESMA asking? It wants the right to exercise power over Indian institutions, that is central counterparties in India, over which legally ESMA has no jurisdiction.
Okay.
So it is indeed a regulatory overreach, an extraterritorial jurisdiction issue.
Got it.
Now, one can argue that, look, and I'm sure RBI may be arguing that India deals in INR, that is in rupees. The rupee is not a fully convertible currency, and it is a comparatively closed market. And we are also moving into T+1 settlement in the stock market. That is a settlement where the stocks and money change hands a day after the trade is executed.
Right.
So where is the big risk? I'm sure these issues are under discussion over the past 1 year. But probably ESMA and regulators can be quite obstinate, if I may say, a standardized uniform MOU for all countries, and they possibly don't want to tweak it or relax it for India. Now, they would say that, look, if other markets like, say, the Hong Kong Monetary Authority or the Singapore regulators, if those guys agree, what is the big deal with RBI? After all, it is a deal between two regulators. There are no commercial organizations involved here. But I guess that the stakes are too big and they will find a way out. And SEBI indeed has already hinted that whatever little we learn, that it is willing to reach some kind of a settlement with certain conditions.
So the RBI is stubborn while SEBI wants to relent. Now, Sugata, I understand that stock market transactions can't happen without clearing houses and hence SEBI's stance. But shouldn't regulators have a uniform stand?
Yes, you're right. Ideally, they should. I mean, all the more because they think that they have a good reason to do so. I mean, it could appear that RBI stand would be weakened if SEBI enters into some kind of an arrangement with ESMA. It seems that the government has taken that kind of an approach. It is willing to wait and see, find out how the negotiations between RBI and ESMA and Bank of England work out. And then, while at the same time, some formula is being worked out by SEBI, and I'm sure SEBI has received the go-ahead from the Finance Ministry to do that. Because I don't think the government would want, particularly the markets are volatile, the rupee is under the pressure, and the government would not want any unsettling developments in the equity market. Because equity market is like a barometer. Because if today a lot of trades, even if these are for a few days, right, before large investors, large wholesale investors, they change their custodian from one bank to another because one particular European bank in India is unwilling to offer the custody business. That would not send the right signal. It can have some impact on the market. And I don't think the government, neither government nor SEBI would want that. Unlike, say, a government security trading or a forex derivative trading, which are changes would not be very obvious there. And those are deals which can still be done bilaterally.
I believe such regulatory squabbles are never made so public, right? How do you see the fact that this one's played out in full glare of the world like this, and that respective governments have had to step in to diffuse the situation?
Well, you see, time is running out. For instance, by April, the European banks, that is the banks in mainland Europe, they'll have to run down their positions, right? So if they have deals which are done through CCIL and other things, they'll have to unwind those deals. And from May, they'll have to do bilateral deals if these differences are not sorted out. So there is not much time. And a month from now, you'll have the Christmas vacation. And for a fortnight, all these regulators and banks, they will disappear and other things. There'll be no negotiations before second week of Jan. So they want to make it public. Possibly they want the debate to happen so that the governments, the regulators, they are forced to take a decision. So it could well be from that particular point of view. But then I agree with you, regulatory tussles don't normally hit the headlines. In fact, regulators, particularly central banks, have long been perceived as very matured, evolved institutions. If I may say, somewhat like a club of Freemasons who quietly sit and sort out their issues over a glass of wine. But the media don't get a whiff of it. Even their respective governments, there have been cases where the respective governments are not fully aware of the implications of what they discuss. The two central banks of two countries. But now that you ask me, I'm tempted to think that perhaps it's a reflection of a world that is changing. We don't know yet, but it may have partly to do with the shifts in the nature of politics and international relations. And the general air of protectionism, which is kind of sweeping the globe. Also, between the meltdown and the pandemic, the regulators may have felt increasingly that they should play it very safe. They should turn conservative. They should ring-fence their markets, their constituencies, their institutions, so that the blame doesn't boil over to them. At the end of the day, they want to shield themselves.
But here's the thing. Is this the first time this is happening? As I realized from my research, no. Indian regulators have had what would be termed beef in internet parlance before. Not just that, I was also wondering if such a public standoff bodes well for both countries. Also, is the RBI being too stubborn in its stance? Should Indian regulators soften a little bit? To answer all this and more, Anirban turned to Viraj Kulkarni, founder and CEO of Pivot Management. Viraj has worked with 3 of the top 5 global custodians for over 12 years as country head of Securities Services with Citibank, India and Switzerland, JP Morgan Chase and BNP Paribas.
Hi Viraj, welcome to the Morning Brief.
Good morning, Anirban. It's a pleasure to be on your show.
Pleasure's mine. So Viraj, we're talking about the ongoing India-EU regulatory rift, right? Now, not many people know that this has happened before. It's actually a history repeat. And it had happened before in 2013. Would you please tell us what that was like?
Yeah, you're right. So this has a precedence. So in 2013, ESMA, which is a regulatory body, came out with EMIR, E-M-I-R, which is the European Market regulations. This regulations required that every clearing corporation to which any of the European banks were exposed to had to be registered under ESMA. Now, in those days, the clearing corporations of India, which is NSEs, BSEs, the clearing corporation, came under the purview.
Right.
This was attempted in 2013 with India, Singapore, and Hong Kong. And I recall I used to be then working for a foreign bank, European bank. It was definitely a shock for many markets, not just India, because ESMA tried to do this with Hong Kong, Singapore, and India, if I remember, in the Asian markets. And India, I remember when this came to SEBI, SEBI engaged the industry in finding a solution. It was also, the industry primarily was the European banks. And SEBI laid out why they would not be comfortable with such an oversight by ESMA, which was understood by the custodian banks, and they relayed the same to the headquarters out there in Europe. The management then, the global management of the respective banks, actually understood the issue and engaged with the ESMA to see that India was not on that list, because this was a significant impact. So I remember there was this whole part of that whole discussion with SEBI, and they engaged the industry, they thought through it, and it was not a knee-jerk reaction saying no. And so I think that approach was good, and I think the same approach will work this time as well.
Viraj, I wanted to ask you, it seems that custodians will face the biggest impact of this. Can you give our listeners an idea of, what they do, sort of how big is the business and how big will the impact be?
Anirban, it's a very interesting question, because a lot of people still do not understand what custodians do. Custodians globally present in over 100 countries and manage over $246 trillion of assets on behalf of institutions. So what do? They primarily act on behalf of the investor. We are talking of institutional investors across the globe. And their actions relate to clearing, settlement, as well as managing cash and engaging in FX for their clients. Now, in India too, the custody business has been in existence for over 32 years. And custodians in India manage $2.1 trillion of assets of the total 3.3 trillion market cap that we have in India. Now, who loses in this? What is the impact on the custodians? Now, before I get there, let me also share, India has 10,900 plus foreign portfolio investors invested in India, of which approximately 2,500 foreign portfolio investors come from Europe.
Okay.
Now, it's not necessary that a foreign portfolio investor will invest through a European bank. They could come through any of the global custodians. So we have a concept called a global custodian, who can be seen as more like a wholesaler. And then we have a country custodian, which is more like a retailer, just an analogy that I'm using. Now, what's the impact? The impact is, if ESMA coming with these regulations, it creates uncertainty in the minds of the clients who are, or the FPIs, who are with the European custodian on the continuity. So the first thing they would do is, because India is still an attractive destination for foreign portfolio investors, the FPIs would just pull out the plug from the European banks and go on to a global custodian.
Okay.
So first is, the impact on the European banks is the possibility of losing business to their competitor non-European custodians. The second part is it also impacts them from participating in domestic mandates. Mind you, when I say domestic mandates, our insurance sector, provident fund sector, mutual fund sector are significantly large. And the European custodians are engaged in having them as a client. Now, this would
Right.
mean that they would have to let go of these clients. And obviously, that's a big hit. So from a perspective of what would change is the European custodian would neither be able to participate in the clearing and settlement for the foreign portfolio investor clients of theirs or for the domestic clients. And in effect, they may lose business. Now, this also has to be seen from a background of the fact that India is the most profitable jurisdiction in the world for a custodian. So I guess I see the European custodians, and one of them is very prominent, which is Deutsche. I'm sure they'll definitely take it back to the management and probably, figure a way out with ESMA to let things lie as it is.
So, what is the impact of such a rift on any jurisdiction? And also, can you give us your candid views on whether you think ESMA has really overstepped?
So that's a very interesting question, Anirban. Now, every single regulatory body in the capital market is a member of ISCO. And that applies for ESMA, it applies to SEBI as well. ESMA being the nodal body, it determines how capital markets has to be run. It lays down the framework. Then it leaves it to each of the respective members to run the jurisdictions. And if you look at, let's say, coming into India, SEBI has done a marvelous job, I would say so, in the last 30 years, being the one which has ushered probably the maximum changes.
Right.
So, in a sense, where India's moved, let me use some examples. India moved to T+2 way back in 2003, whereas the European markets went live, though they are advanced markets, they went live only in 2014.
Okay.
Today, we are the only country in the world to have T+1 and T+2 running successfully, and T+1, with 4,000 scripts, has no parallel anywhere else in the world. So,
Correct.
in a sense, there is an overreach, I think, from ESMA on trying to regulate the Indian capital markets. I mean, if they wanted to regulate the performance of the European banks, that's understood. But why try to regulate clearing corporation of another jurisdiction? So I think this is a significant overreach, and it does not help build relationships between ESMA and any of the market it's trying to impose such conditions.
How do you see this playing out, and how do you think this will be resolved?
See, it has multiple factions. I'm sure the regulators on either side, which is ESMA, SEBI, RBI, are seized with this. They work on many areas, and I'm sure this will also pan out to the satisfaction of everybody. The way I look at it is maybe ESMA would look at collaborating with the SEBI and RBI to look at the best practices in India and sort of convince themselves that India has better practices. It's a safer country. It is a better country it manages its risk better. And probably, that's the learning they would take away and back off. I mean, that's the thing. If I look at the 42 countries which are on the list, they're all small compared to India. So India is a significant market for European investors and European banks. Second is India, in fact, stepped up in 2013 by requiring its clearing corporations to just do a registration with ESMA, though there was no need. This was done to facilitate European banks to do business in India. The second important thing to know is since 2013 to 2022, the Indian capital markets have only grown, and we expect growth to happen by another 50% on the custody space. So It's in the interest of ESMA to resolve this as soon as possible, because this will primarily impact the European banks' participation in the Indian markets. And to that extent, India is a significant jurisdiction for most of the European banks. And I'm sure they would not like to lose their business, whether domestic or the foreign portfolio of FPI space, to the competitors. So I think this is where the banks would have to step up and again reach out to ESMA to see or revisit to what they are seeking now.
Viraj, what can be done, you think, to make our own banking sector more prolific in this space?
it's time for India to start looking at developing its own banks. I say this because Atmanirbhar is what we talk about, but let's bring Atmanirbhar into our capital markets. Just as ESMA engages, on behalf of European banks, I think it's in India's interest to develop its single country custodians. A single country custodian is a custodian who is present only in one or two countries. We have quite a few of them, ICICI, HDFC, Axis of the world, etc., who are very good expertise on the custody business. So the way to strengthen the European participation is allow limited banking license, a subject which RBI tabled in 2014, to happen. Now, what does this mean? So we have quite a few custodians which are India-based, India-centric, which do not have a banking license. However, they're equally good, if not better, than some of the European banks who are doing custody business. Mm-hmm. And these are, if I have to just name a few of them, it's Stock Holding, it's Edelweiss, Arbes, and a few others, or totally about 5 of them. Now, What's happened with these banks is they do not have a banking license. The moment they have a banking license, which is a limited banking license on the lines of what globally exists in a State Street and a Northern Trust or a Bank of New York Mellon, are limited bank license holders, then it allows them to start offering high quality services and reduce the risk. So I think RBI has to really bring this up, start giving them limited banking license to the Indian institutions. And I think we will make our markets more secure.
I started off wondering if it was hard to believe that regulators were squabbling in the open. But after listening to what our guest had to say, a lot has been cleared up. It seems to me too that the otherwise mature institutions would only fight it out in public if they knew they couldn't sort it out through dialogue behind closed doors. The SEBI might be softening its stance, but it looks unlikely that the RBI will give in. And from what I can tell, it seems like they have every reason to stand firm, considering this could be termed regulatory overreach. One thing is for sure though, a lot is at stake, as 20% of foreign investors that buy Indian securities are in Europe. Finance ministries in India and European countries are trying to convince their regulators to come to a middle ground, given India and EU's improving relations. But will this happen, or will there be more drama? Who will blink first, India or Europe? Keep listening to the Morning Brief as we stay on top of all that's happening in business, economics and finance in India and across the globe. A big thanks to Anirban for the breakdown and insights with in-house expert Sugata and industry veteran Viraj. Well, that's it for today. It's Friday, November 25th. I'm your host, Rekhi, and you are listening to India vs. Europe Regulatory Rift on the Morning Brief from the Economic Times. This episode was produced by Sumit Pandey, sound engineer Indranil Bhattacharjee, executive producers Anupriya Bahadur, Anirban Chowdhury and Arijit Burman. Do share this episode if you liked it, and listen to new episodes of the Morning Brief every Tuesday, Thursday and Friday on all your favorite listening platforms, including Amazon Music, Ghana.com, Spotify, Apple and Google Podcasts, the Economic Times website, and of course our very own audio platform ET Play. Also, tune in to the latest podcast from ET, Startup School with Suresh Venkat, your 12-step guide from idea to enterprise with marquee startup founders. Catch the latest episode every Friday on your favorite listening platforms.